Puneet Chhatwal, who's MD and CEO, speaking to my colleague Avan Dabash about their debt, international properties and long-term growth plans to maintain their leadership position.
I actually feel that the company did a right thing by being present in the two largest lodging markets of the world. So I think we are blessed to be present both in London and in New York. Our presence in San Francisco, Boston or Cape Town or Dubai or Maldives has been actually positive for us. So yes, one or the other acquisition sometimes did not work out the way it should have worked out, but let's look at the positives and see how we can build on that instead of complaining about one asset. There is always one or the other asset, even in our home soil, which doesn't go right.
Okay, as a strategy that the company is adopting, I understand it's going to be an asset-light model where you're looking at now entering management contracts instead of owning properties. Is this the way forward for the company or for the industry as a whole?
If there is a compelling proposition, which is very strategic in a key city and actually helps us improve our margins, we would invest. We are not averse to investing money. So a one-size-fits-all, like now it's all going to be asset-light, management contracts only, this doesn't work and it's actually not the right strategy. This has come mainly from overseas companies for which I've also worked in my career. And maybe the Indian subcontinent is not a strategic destination for them to invest. But I think it's up to us, the people who've been here, the companies who are relevant for this market, to actually find the right model for themselves. So let me give you a few examples, which I've also given in the past. We take Taj Lands End that we own. The amount of EBITDA that hotel makes, you need at least 20 management contracts to replace the profitability of that one hotel. If we take this hotel, the Taj Mahal Palace and Tower, maybe you need 30 to 40 management contracts, because that's the kind of management fee income that would be needed per hotel to come close to the EBITDA of this hotel. And I think we need to do both, because when you own a property or when you own the business, your margins are lower because you also own the P&L. When you have a management fee income, it's only the management fee income getting added to the total revenues. So you don't own the business, so your profitability as a percentage is higher. Then it gets a little bit more complex when you go down the pyramid. So if we are in a what we call the lean luxury segment of Ginger, as one of our brands, maybe it's good for us to own the business and lease properties, because the amount of fees you will get on a 60 or a 80 or a 120 room Ginger would be so less that it may not justify being present with that kind of a model in any market if it was not Mumbai, Delhi, Calcutta, Bangalore, Hyderabad, etc.
Let's get down to business, talk the financials as well. Walk us through some of the highlights of the quarter gone by. You said seasonally that Q2 is the weakest of quarters. How has Q1 been for you? What have been, some of the key drivers or the key challenges you faced?
It is true that the first half of the year actually has been approximately 30% of our total revenue for the full financial year, and the second half produces 70%. And Q2 has always been the weakest quarter, followed by Q1. Having said that, we have had an 8% growth on the top line, driven mainly by increase in market share and partially inflation and the tailwinds that we are getting on the increase in RevPAR in the industry. But more importantly, we have had a 26% growth on the EBITDA margin. Because our margin expanded by approximately 2%, 183 points to be precise. So given that it is after 2008, I think that we have had a profitable Q1 on a profit after tax basis, and we are happy for that kind of performance. Going forward, we feel that we will continue to deliver on our margin expansion story that we communicated to the market in February during the Capital Market Day. And if nothing significant happens in the market, if everything continues this way, I think we are well positioned to drive both margins as well as top line. One thing that has really been a game changer for us and will help us in 2 to 3 years from now is our year to date. Besides the Q1 adding whatever till 10th of August, we have added 10 more contracts to our pipeline, and day before yesterday we signed for a Vivanta at London Heathrow with a Bombay Brasserie restaurant. I think this is pretty significant in 5 months' time to have signed 10 new contracts and added them to the pipeline. And we feel from a growth perspective in adding new contracts, this will be a very important year for us.
The debt position, when it comes to a lot of luxury hotels as well, that seems to be the stumbling block, if you will, as it is for Indian hotels. What is the overall debt position that you're currently sitting at? And analysts are saying that by the end of FY19, we can see the overall net debt equity at less than 1 time. What is the plan for reduction of debt?
I think maybe the analysts know many things that I don't know. I think it is our endeavor to have a debt position which is smaller than what it is today.
Which is?
Today is at 2.58 times the EBITDA. I think so it has to go down further. That would be good for our portfolio. However, having said that, it came down to 2.58 after the rights issue, which was very successfully done last year, and a lot of debt was repaid. And we hope to continue on that journey without the rights issue by paying whatever debt we can pay through our, operating cash flows.
And are there plans for selling off of non-core assets?
Yes, we have announced that. So over the years, we have been collecting a lot. So we would be selling some of the non-core assets, and we have organized.
So what's on the anvil now?
We have collected a lot of, apartments, for example. So maybe we are able to sell some of that.
Now, what about the changes in the GST policy? What did that do for the hotel sector as a whole? Because I believe now tax will be levied on the actual transaction value as compared to the earlier policy of tax on the declared tariff. For some of the luxury properties, doesn't make too much of a difference. I think
it's not about luxury or others. I think this business should be taxed as less as possible. See, globally, any job created in a hotel creates 4 to 8 jobs in the community. And if employment is anybody's strategic initiative, they should tax hotel and tourism business as less as possible. So I think we had some good news on the GST a week or 10 days ago. I hope it will not stop there.
At the helm, what are your plans to take the company forward? The street or investors have always appreciated, the efforts that have been taken in terms of margin improvement or cost optimization. What are the few things that you would like to do, or changes that you would like to make, or strategies that you would like to drive forward?
Well, we have articulated it in a very simplistic way. We want to stay the most iconic, but we also want to be the most profitable. And that is in all the businesses that we are in, whether it's in our shopping business with Khazana, or it's in our 75 spas with Jiva, or it's in our salons, or it's in our brands like Taj or Ginger or Vivanta or the newly launched Selections. We want to have the leadership position. And wherever we are already leaders, we want to defend that position.